Imagine looking at a major tech company's recent financials, right? And you see this revenue is just completely stagnant. Net income has literally gone negative. They are just bleeding billions in capital expenditures to keep their factories running.
Yeah, in a rational market, you'd expect that stock to be heavily penalized.
Exactly. But today, April 14, 2026, Intel is doing the exact opposite. I mean, it is up 4.49% on the day, capping off this historic, just jaw-dropping 9-day winning streak. The stock has skyrocketed 56%.
It's wild.
It's currently trading at $65.18. So the question we're exploring today, it's simple, but incredibly high stakes. Are we looking at the greatest, most profound turnaround in modern tech history? Or is this a $327 billion trap, perfectly engineered to crush retail investors?
Well, we are looking at a market that has completely detached a company's present-day financial reality from its future narrative. And to figure out which side is going to win that tug of war, we really have to pull apart their raw financial statements, their strategic moves, and some incredibly stretched technical indicators.
Right.
But just to set the ground rules before we get into all this data, we are analyzing market trends for educational and informational purposes only. This is absolutely not financial advice.
Yeah, definitely not financial advice. And hey, before we really get under the hood here, if you enjoyed this deep dive, please take a second to like the video and subscribe to our YouTube channel. And it's compulsory that you leave your comments and feedback down below. We want to know what you think about this stock.
For sure.
All right, so let's start with the present-day reality, because the numbers here are, well, they're deeply contradictory. If you just glance at the chart over the last year, the 52-week range is incredibly wide. I mean, the stock was left for dead, down at $18.25.
Yeah, it was practically a penny stock in the eyes of institutional tech investors.
Right. And today, it's brushing right up against its high of $65.80, and the market cap is sitting at $327.27 billion.
Yeah.
But if you open up their fiscal year 2025 income statement, how does the actual business justify that valuation?
It doesn't.
No.
Not at all. If you look purely at the operations, the engine is sputtering. Revenue for the fiscal year was entirely flat year over year, coming in at $52.85 billion. And worse, they didn't even turn a profit on that revenue.
Wait, really? No profit at all?
Right. Their net income actually dipped into the red at negative $267 million. And if you zoom in on the fourth quarter of 2025 specifically, revenue growth didn't just flatline, it actually shrank by 4% compared to the previous year.
Wow. Okay, so if the company's shrinking and losing money, Wall Street clearly isn't buying the stock for what it is today.
Yeah.
But, when you dig into the cash flow statement, there's an interesting detail.
Yeah, the operating cash.
Exactly. They aren't losing money because people just stopped buying their legacy chips.
Yeah.
They actually generated a very healthy $9 billion in cash from their day-to-day operations.
Yeah.
So where exactly is all that cash going to result in a negative net income?
It's being entirely incinerated by capital expenditures.
Incinerated. I like that.
I mean, it literally is. They spent negative $14.65 billion on physical assets, infrastructure, and equipment. The core mechanism to understand here is their strategic pivot to what they call IDM 2.0.
Right, the foundry model.
Exactly. Historically, Intel was an integrated device manufacturer, meaning they only built factories to manufacture the chips they designed themselves. Now they're pivoting. They want to build factories to manufacture chips designed by their rival.
That sounds like they're fundamentally changing the DNA of the whole company. It makes me think of like a massive home renovation.
How so?
Well, you have a functional, slightly outdated house that's still keeping the rain out.
Yeah.
That's their legacy chip business generating the $9 billion in operating cash.
Okay, yeah. But instead of just painting the walls, they are ripping out the plumbing, knocking down load-bearing walls, and living in the drywall dust while trying to build out this massive futuristic smart home edition.
That's a really good analogy.
Mm-hmm.
And to push that further, they aren't just paying for this renovation out of their savings. They are financing it.
Though with debt.
Heavily. If you look at their balance sheet, total assets have grown significantly to $211.43 billion. Their total equity has strengthened to $126.36 billion. But the debt-to-equity ratio is creeping up to 0.67.
So for every dollar of equity, they hold 67 cents in debt.
Right. The market is watching that trajectory closely because Building cutting-edge semiconductor fabs is arguably the most capital-intensive industrial process on the planet. So the financials reveal a dusty, cash-burning construction zone. If that's the current state of the house, why is the market pricing the property as if the renovation is completely finished, fully furnished, and, generating rental income? There has to be a catalyst totally overshadowing the negative net income.
There is. The market is buying a geopolitical and technological narrative. Wall Street is suddenly viewing this company less as a struggling legacy PC brand and more as critical sovereign AI infrastructure.
Ah, sovereign AI infrastructure.
Yeah, and you can see this shift in the mechanics of their recent corporate maneuvers. Take the $14.2 billion Apollo Fab buyback.
Okay, that deal is fascinating because they just bought back a 49% stake in their own Ireland facility, Fab 34. But wait, why would a company sell a massive stake in its own factory to a private equity firm, only to turn around and buy it back later?
It basically comes down to the cost of capital. A few years ago, when interest rates spiked and they needed billions to build these factories, taking on traditional debt would have completely destroyed their credit rating. So they did off-balance sheet financing with Apollo.
Got it.
They basically gave up a share of the factory's future profits in exchange for upfront cash. Buying it back now for $14.2 billion is a massive flex. It signals to the market that they want 100% of the future cash flows from their leading-edge facilities in Europe, and they are willing to leverage up their balance sheet today to regain total control.
And it isn't just private capital flowing in, right? They recently finalized $7.86 billion in direct funding from the U.S. government's HEPS Act. That looks like a massive geopolitical shield.
It absolutely
It's
is.
like the U.S. and Europe are essentially deciding that they simply cannot rely entirely on Taiwan for advanced manufacturing anymore.
That sovereign backing acts as a floor for the stock's narrative. But, government funding only gets the factory built. To actually make money, you need clients. The foundry model only works if the biggest tech companies in the world actually trust you to build their silicon.
Which brings us to the partnerships.
Exactly. That is why the recent partnerships are driving this 56% rally. They announced major collaborations with Elon Musk's Terafab project, and more importantly, deepened ties with Google Cloud to build ASICs.
Let's break down ASICs for a second, an application-specific integrated circuit. Basically, instead of Google buying, off-the-shelf general-purpose graphics cards from a competitor, they're designing highly specialized chips, custom-built exclusively for their own AI algorithms.
Right.
So if this company can prove they are capable of manufacturing those custom Google chips efficiently, that completely validates the entire IDM 2.0 foundry experiment.
It proves they can service third-party clients. But the technological holy grail driving the current frenzy is the report that their 18A process, the Panther Lake chips, has begun initial shipments.
18A.
Yeah. In the semiconductor world, a node refers to the generation of manufacturing technology. The smaller the node, the more transistors you can pack onto a chip, making it faster and more power efficient. The 18A node is their attempt to completely leapfrog their dominant Asian competitors and reclaim the title of manufacturing the most advanced silicon on Earth.
Okay, so you combine a $7.8 billion government check, massive Google partnerships, and reports that their next-generation silicon is actually shipping. You can definitely see why retail investors are aggressively buying the stock in the mid-60s.
Oh, absolutely.
But let's look at the people actually inside the building. I mean, if the 18A node is truly a historic leapfrog and the foundry model is guaranteed to print money, I assume the executives are just loading up on their own stock.
You would think so, but the insider trading data over the last 90 days tells a completely different story. Yeah. The executives, the people with direct access to the supply chain metrics, the actual fab yields, and the real profit margins, have been net sellers to the tune of $1.71 million.
That is a glaring disconnect. I mean, I know CFO David Zinsner did buy about $250,000 worth of stock back in January 2026, but he got in when the price was down at $42.50.
Right.
Meanwhile, the chief legal officer, April Miller Boise, unloaded almost $1 million worth $981,000 in February 2026 when the price hit $49.05.
The ultimate takeaway here is really a tale of two timelines. Retail traders are looking at the headlines and buying a 10-year geopolitical narrative.
The dream.
Right. The insiders, however, are looking at the balance sheet and trading the 6-month financial reality. When executives are cashing out significant positions at $49, it strongly suggests they believe the short-term risks outweigh the long-term hype at that specific valuation.
So if the insiders were tapping out at 49, what exactly does the technical data say about retail traders piling in at 65 today? Have they completely missed the boat, or is there structural momentum keeping this thing afloat?
The technical charts are flashing some of the most extreme, polarized signals you will ever see on a mega cap asset. Let's look at the core trend first.
Okay.
It is undeniably bullish. The price action over the last 9 days has essentially violently invalidated all historical resistance levels. The moving averages are trying to catch up, but they are lagging severely. The 50-day moving average is sitting way down at $47.54, and the 200-day is trailing at $36.41.
Wow. A stock trading almost $20 above its 50-day moving average implies just incredible momentum.
The momentum is massive, and you can see it in the MACD, the moving average convergence divergence. This indicator looks at the relationship between two moving averages, usually the 12-day and the 26-day. When the shorter-term average pulls far above the longer-term one, the MACD line rises. Right now, it's sitting at 2.76, maintaining a solid buy signal well above the zero line.
But, momentum isn't infinite. Eventually, a stock that goes straight up runs out of new buyers. What are the warning signs that this rally is just overextended?
The loudest warning siren is the 14-day RSI, or Relative Strength Index. It measures the speed and magnitude of recent price changes to evaluate if an asset is overvalued.
And usually, anything over 70 is considered heavily overbought, right?
Exactly. Right now, this stock's RSI is sitting at an extreme 76.58.
76. Okay, think of the stock's 50-day moving average like a dog walker, and the stock price itself is the dog on a leash. Right now, with an RSI of nearly 77, the dog has sprinted to the absolute end of the leash.
Yeah, it's choking itself.
Right. It physically cannot keep running at this velocity without either dragging the walker forward over a long period of time or violently snapping back to the center.
The math demands a reversion to the mean. An RSI of 76.58 doesn't guarantee a crash tomorrow, but it practically guarantees a period of consolidation or sharp price correction. The stock is currently testing resistance right at its all-time highs near 65.80. If the buyers exhaust themselves here and the price gets rejected, the technical support levels are a long way down.
How far down are we talking? Like, if the leash snaps back, where's the floor?
Well, the first key support level isn't until $55. And if that psychological barrier breaks, the next major structural floor is established way down in the $48 to $50 range.
Which happens to be exactly where the executives were selling.
Precisely.
And that downside aligns perfectly with how Wall Street analysts are currently modeling the stock.
Yeah.
If you look at the 41 major analysts covering this ticker, the consensus is a heavily cautious hold. You have 33 holds, 6 outright sells, and only 9 buys.
The analyst price targets really quantify the downside risk of this overbought technical setup. The average price target is $48.96. That implies a massive 25% drop from today's trading price if the AI narrative cools off.
Eggs.
Now, there's always an outlier. Northland has a highly optimistic target of $92, but the lowest target on the street is a brutal $14.
14. Okay, so we have a situation with profound contradictions here. The charts show undeniable aggressive buying momentum, but flash extreme overbought warnings. The U.S. government is handing them billions, but insiders sold lower. Which brings us to the ultimate debate for anyone holding or watching this stock right now. Is this a genuinely undervalued turnaround story or a catastrophic value trap?
To settle that debate, we really have to look at the pure valuation metrics, totally separate from the charts in the news. The trailing PE, the price-to-earnings ratio, looking at the past 12 months of actual performance, is non-existent.
Because of the negative income.
Right. It's negative because they lost $267 million. You are paying a premium for a company that currently loses money on every chip it sells in aggregate.
But, the market is forward-looking. What about the anticipated earnings for next year?
The forward PE is a staggering 139x.
Oh, my goodness.
Yeah, you are paying 139 times the expected earnings for the next 12 months. To put that in perspective, proprietary quantitative models like GF value, which calculate an intrinsic fair value based on historical multiples and business fundamentals, they suggest the stock's actual value is around $26.96.
Wow.
By every traditional metric of value investing, this stock is massively detached from reality.
I understand the fundamentals look grim, but I'm going to play devil's advocate here and argue the bull case.
Okay, let's hear it.
The traditional PE ratio completely fails to account for national security.
Yeah.
This company is executing a strategy they call 5 nodes in 4 years. Historically, advancing a single semiconductor manufacturing node takes years of research. They're attempting to push through 5 generations of technological advancement in just 4 years to catch up.
It is an incredibly audacious pace. I mean, they are pushing the absolute physical limits of Moore's Law.
Exactly. And if the reports are true that the 18A Panther Lake silicon is successfully shipping, it proves they're actually pulling it off.
Yeah.
With geopolitical tensions constantly threatening Asian supply chains, the West absolutely requires a domestic foundry capable of producing AI chips.
Sure.
If they become the default sovereign-backed manufacturer for the entire Western world, and PC and data center revenues recover through the back half of 2026, as expected, I mean, paying 139 times forward earnings for a protected, subsidized monopoly might actually be a bargain.
Okay, the geopolitical shield is real, I'll give you that. But the execution risk in the bear case is massive. Let's look at the reality of becoming that subsidized monopoly. It requires capital.
Right.
To get that capital, they had to take on massive debt. Remember the $14.2 billion Apollo buyback?
Yeah.
Adding that much leverage to the balance sheet creates immense interest expenses. Even if they successfully manufacture the chips, the cost to service that new debt will ruthlessly compress their profit margins for years.
But surely the revenue from these new Google and Musk partnerships will offset the debt.
It might eventually, but it hasn't materialized in the filings yet. We just established that revenue in Q4 shrank by 4%. The trap here is psychological. Retail buyers see headlines about Elon Musk, AI, and Shivshak Act funding.
Exciting stuff.
It is. Those are visceral, easy-to-understand concepts that feel inevitable. They fall in love with the idea of a Western tech resurgence.
They are buying the beautiful 3D renderings of the finished smart home renovation,
while entirely ignoring the contractor's bill. Exactly. They buy the future narrative without pricing in the billions of dollars it costs to get there, the massive debt load, the negative net margins, and an RSI of 76 that practically guarantees a short-term pullback. The market can run on a story for 9 days or even 9 weeks. But eventually, the market demands actual profits, not just promises.
Okay, so synthesizing the geopolitical narrative with the grim financial reality, what is the actionable outlook here? Where do the technicals and the fundamentals converge for you?
In the short term, volatility is the only certainty. When a stock is stretched this far above its moving averages, with an RSI pushing 77, it is highly susceptible to sudden, sharp corrections on any piece of bad news.
Long term.
In the long term, over the next 2 to 3 years, the entire valuation rests on one single pillar. Can the IDM 2.0 foundry model achieve actual profitability by 2027? If they prove they can manufacture complex chips for third parties without bleeding cash, the narrative holds. If they can't, the massive debt and negative margins will act like an anchor.
And the market is about to get a massive reality check on whether that profitability is actually on track. The next major binary event for this stock is the upcoming earnings report, scheduled for April 23, 2026.
That is just 9 days away. It is going to be one of the most scrutinized, high-stakes earnings calls in the entire semiconductor sector this year. Analysts are going to be dissecting every single word regarding the 18A yields and the foundry profit margins.
We just mapped out a company trading at a massive 139 times forward earnings, operating with a negative trailing PE, taking on heavy debt, and pushing extreme technical limits. They are priced for absolute flawless perfection. So as we count down the next 9 days to that Q1 2026 earnings release, consider this. What happens to a historic 56% momentum rally if their heavy cash burn causes them to miss Wall Street's expectations by just 1 single cent?